This exclusive tutorial will teach you everything you need to know about Forex trading. You want to learn Forex trading? Follow me as I put you through step by step. Welcome to Keys FX. Without further ado, let's get on to this video. Welcome to a complete beginner's guide into Forex trading. Forex trading, also known as foreign exchange trading, involves the buying and selling of currencies with the aim of making profits. And of course, it's the largest financial market in the world, trading trillions of dollars daily. Now, if you're a beginner, here are step-by-step guides to help you getting started in understanding everything you need to know concerning the Forex market. Understanding the basics of Forex trading. Now, what is Forex trading? If you've ever traveled from one country to another and you have to exchange their currency to that of your local currency, you have actually participated in Forex trading. Now, simply put, Forex trading is an act of you exchanging one currency to another, like you're exchanging Euro to USD or you're exchanging GBP to Japanese yen. Who are the participants of the Forex market? Now, the participants of the Forex market are basically banks, big corporations, governments, and individuals. These are the participants of the Forex market. What are the times that the Forex market is open for trading? The Forex market is actually open 24 hours a day, 5 days in a week across major financial centers, which is the New York, the London, the Tokyo, and the Sydney. Now, here is a graphical representation of how those time frames actually overlaps themselves. Now, before you can know anything about the Forex market, the first things you need to know are the key terminologies or the key terms of the Forex market, so you can be able to understand all about the Forex market. And one of the key terms of the market is currency pairs. A currency pairs is a quotation of two different currencies in the Forex market, where the first currency is quoted against the other currency. And the first currency that is quoted is regarded as the base currency, and then the currency that is quoted against is regarded as the counter currency. Now, this is done to reflect the exchange rate between the two. So you have two currencies and then one is quoted against the other. And these quotes are done to represent the value of those currencies against the other currency. Though this is what currency pair is all about. As you can see on this graphical representation here, you can see this is an example of how the currency pairs usually looks like. Now we have GBP USD, and then the GBP right here is the base currency, and while the USD right here is the counter currency. Now the characters of this GBP here is that firstly it's regarded as a base currency, that is you are buying this GBP. So whatever you do, you are buying this GBP, and then this USD is a currency that you are selling. So this is the true difference between the two currencies that is being quoted. So this two currency right here is what we call a currency quote. So you see something like this is a currency quote. So that is how the market actually works. What are the types of currency pairs that we have? Now we have three major types of currency pairs. Now we have the first one being the major currency pairs, the second one being the minor currency pairs, and the third one being the exotic currency pairs. So these are the currency pairs we have in the Forex market. Major currency pairs are the currency pairs that mostly involves the US dollar, and we have about 7 of them involving the US dollar. Like as you can see in this graphical representation here, we have the Euro USD, the USD JPY, the GBP USD, we have the USD Chef, we have the USD CAD, and then we have the AUD USD, and then New Zealand dollar USD. So these are the major currency pairs we have in the Forex market. So this is what we regard as the major currency pair because they involve the US dollar in it. The other type of currency pairs that we also have is called the minor currency pairs. Now, just like the opposite of the major currency pairs, we have the minor currency pairs. So these are currency pairs that do not involve the US dollar. So these currency pairs do not actually involve the US dollar. Like as you can see on this graphical representation here, we have Euro JPY, and then we have Euro AUD, we have GBP JPY, and a host of them. So any currency pairs that do not involve the USD is what we call the minor currency pair. So these are the currency pairs that are regarded as the minor currency pairs. Basically, there are about 11 of them. So these are the minor currency pairs that we have in the market. The last but not the least type of currency pair we have are the exotic currency pairs. Now, this is kind of a little bit different from the major and the minor currency pairs. Now, the exotic currency pairs are currency pairs that are from developing countries, are countries that have smaller economy, that do not have strong value like that. So, like as you can see on this graphical representation here, we have the USD ruble, which is of course the Russian ruble, and then we have the USD African rand, and then of course we have the USD Mexican pesos and the likes of them. So these are the exotic currency pairs that we have. So there are quite a lot of them. So any currency pairs that is coming from a developing country where their economy is not that big, these are what we call the exotic currency pairs. Now, the number two terminologies or terms that you need to know if you want to understand the forex market completely is, of course, currency quote. Now, a currency quote is the price of a currency being expressed in terms of the other. Now, it shows the amount that is needed in buying the other currency. As you can see in this graphical representation that we have here, now this is a currency quote. We have the USD Euro, which is of course quoted at 0.8425. Now, this is the quote of this currency right here. This is the base currency, and of course you are buying the base currency, and this is a counter currency, which is of course the quote currency as well. You are actually selling this. So this amount is what you are needing to buy this currency, or you are needing to sell this other currency. So this is just how this graphical representation expresses right here. The component of a quote, currency quote, of course, it has to have two currency, that is the base currency and the counter currency. Right here, as you can see on this graphical representation, we have the USD Euro. So the USD right here is the base currency, while the Euro is the counter currency, also known as the quote currency. Types of currency quote. Now we have three major types of currency quote, and the first one is the direct quote, second one is the indirect quote, and the third one is the cross currency quote. What is the direct quote all about? The direct quote is actually a domestic currency that is being quoted. Example of this is the Euro USD. So the Euro coming first. The Euro is actually the local currency, while the USD is the counter currency, being the higher currency right here. So when the Euro comes first and the bigger currency comes second, that is where we have a case of a direct quote. So this is a case of a direct quote. Now, a direct currency quote is when a domestic currency is the quote currency, that is the currency that is highest being the quote currency. Now, as you can see on this graphical representation here, an example of it, we have the Euro USD. Now, in this graphical representation here, the Euro right here is, of course, the lesser currency, and why the USD is a higher currency. So when the USD is regarded as the quote currency, that is where we have a direct currency quote in this case. The indirect currency quote. Now, what is the indirect currency quote? Just the opposite of the direct currency quote. Now, the indirect currency quote is when you have the domestic currency being the base currency, that is the higher currency comes first in the quote. So that is where you have the indirect currency. Like you can see again in this graphical representation that we have here, we have the USD Euro. Now, this USD right here being the base currency is the highest currency, and then this Euro is of course the lesser currency coming as the quote currency. So this is an example of the indirect currency quote. Cross currency quote is the currency quote that do not involve the US dollar. Like you have the Euro GBP or you have the GBP Euro. So the likes of currencies that do not involve the US dollar is the cross currency quote. Now, as you can see on this graphical representation we have here, you can see that we have GBP Euro. So the GBP right here and the Euro, we don't have any USD pair inside. So this is an example of the cross currency quote. The third terminology that you need to know if you want to learn about forex trading is, of course, pips. Now, what is pips? Just like it's puts, the pip is regarded as the percentage in price point, or you can call it the price interest point. This is what that pip represents. And now, what is this pip all about? Now, the pip is a unit that is used to measure the change in between the two different currencies that is being quoted. So the change in the two currencies that is being quoted in the price movement is of course what we regard as the pip. This usually in the currency quote, it's usually the fourth decimal point in the currency quote. So the difference between the two currencies and the fourth decimal is actually what the pip is. So the difference in the price movements of the fourth decimal is what a pip is all about. Now, as you can see on this graphical representation here, we have the Euro USD, and then the Euro USD is the euro is actually quoted for 1.14988, and then the USD is quoted for 1.14998. So this is the price in between the two. Now, as you can see on this graphical representation, the fourth decimal, which is of course in the euro side, you see the 8, and then the USD side, you see the 9. So this is actually what we call the pip. So the difference between this and this, of course, you can see if you minus 9 from 8, you have 1. So that is what we call 1 pip. So that is how the pip is actually calculated. So the difference between the price of the two currency quotes is actually what we call the pip. If you watch this video to this time, please kindly smash the like button, turn on your notification bell, and of course subscribe to this channel so you can be getting more content from this channel. Until I see you again, keep making every pip count. Peace out.